So I'm sitting here with Matt. Matt is co-founder of HOA Capital. HOA Capital does financing loan services throughout the country for community associations. Matt's also my brother, so it's fun to be able to sit and chat with Matt. HOA Capital, Matt, I want you to talk a little bit about when the company started. What was your vision? What were you seeing in the space, the HOA space, that made you want to start HOA Capital?
Yeah, I mean, it started by accident, like totally by accident. I mean, you know that. I was calling you when I had this idea, this crazy idea in the parking lot. But I can back up a little bit and give you more of the background and how we got to the genesis of this whole thing being started. My experience was in commercial lending and multifamily real estate investing. And so worked for a bank here locally and grew that portfolio to a nice size, and they wanted to diversify their balance sheets and get other assets identified. And so we piloted a program for association lending, and it was a huge success. Terms were a lot tighter, rates were a lot.
They were with your local bank.
Yeah, yep, with the Singular Bank, who was my employer at the time, and there was just a lot of fruit to be picked in the market. You know, Minneapolis, St. Paul metro, greater metro. And what we noticed was just a lack of representation for a couple people involved. And so board members maybe didn't have a resource on who to call. Managers maybe felt overwhelmed just because their workload was so great when it came to a loan request. And they were so infrequent. Like one year they might budget it for a project, and the next year they might need to do a project out of happenstance because the useful life failed them. And so
you're getting requests from property managers
or
alongside board members.
Correct.
So it's not just for, self-managed boards that don't know what to do. You're a huge resource for management companies and their staff.
I'd like to think so. Yeah, for them and boards too, who are independent, unmanaged boards. Yeah, because for us, if we compartmentalize it, management companies want their managers managing the property. They don't want them, being an expert lawyer or an expert accountant or an expert insurance agent or an expert banker, lender. And so for us to be able to take the heavy lift off that manager's desk is huge. It's huge. It should open them up to being able to do their job. You know what I mean? And we're the professional that can step in, carry that for them, let them know where they're at in the process, and also bounce ideas of, hey, here's where you're at in the process. These are the loans that we have, the proposals that we have. We're going to be talking about this with your client, and here's what we're thinking for a closing date.
And in fairness, managers really shouldn't need to know all that, right? So jack of all trades, master of none. Why not bring somebody in that really knows this space? I think.
Well, and we cost the management company $0.
Right. Win-win.
Yeah.
Win-win. They look great in front of their client. They get the product that they need quickly.
Yeah,
and then,
relatively speaking, boards in this industry, things move glacially, right? I mean, they're slow. And so some boards may have more autonomy and have everything ready to go, their house in order sooner, right? They have contractor bids set up, their homeowner the vote has passed, assessments have been passed, and they're ready to go. And some are a little bit slower.
What's different about people think about loan officers and financing, what's different about HOA loans than, your traditional mortgage, or like what makes this kind of a unique niche or a unique opportunity for a company like HOA Capital? Why hasn't everybody figured this out? You know what I mean? Like why are more people not doing this? What's the challenge that a board member might face or a property manager might face in saying, I'll just try to do this myself?
It's a good question. I don't think it can be answered with one specific answer, so I'll try to cover all of it. It's a very unique blend of specialties. So to have the experience in finance and then to also have had the experience I've had in property management, being raised around it my whole life, is unique. I don't think many people have that background, and so that was a blessing in disguise. Also, for lending, It's very different than your traditional lending options. There's no mortgage as collateral. There's no guarantor as collateral. There's no appraisal needed. You're borrowing money to an entity that's a nonprofit designed not to make money, and so we have to peel through the financials and look at what their net operating income is and understand if there's any kind of financial add backs we can include to help offset the debt service coverage ratio that's required by the bank. You know what I mean? So it almost feels like another language to people who aren't in it every day. HOA Capital is unique because for us, we quarterback everything for them. We are the ones who understand the playbook, and we're telling them where to be and what to expect. We're not biased to a specific lender. If I worked for Bank A, I'd want you to take Bank A's proposal, right?
Mm-hmm.
And then the minute you like Bank A, that banker leaves, or they close the door on HOA lending because their capital is crunched, and so
Right.
now you
So
don't
you
know
have no
what to
skin
do.
in the game.
I
You're going out there finding the best lender for this community.
yeah, I'm tailoring a product that I'm tailoring a product that fits specifically the needs of each HOA's request, which are different in states. They're different in loan dollar size. They're different in structure. I mean, it's never the same, dude. Like
Right.
it's always different. And so for us, that's what I enjoy best is like, I love the challenge of putting this puzzle together and making them feel like, hey, this is what we needed. Maybe we're a 20 unit, maybe we're a 15 unit association that no one's touching because we're under a certain unit door size. That doesn't mean you can't get financing. We just got to figure out how to get financing. There are banks out
Mm-hmm.
there that'll do it.
Mm-hmm.
And there are other options, whether that's private money. Ultimately, it boils down to, do you want to assess your homeowners? Do you want to assess them one time? Or do you want
Well,
to
we all
come?
know that goes along like a fart in church, right? The second the board is going, let's talk about a special assessment, it's not going to typically go that well unless the homeowners have somewhat of an understanding of the situation that they're in within their community. Like, yeah, I get it. It's not looking great. I do want to talk about how safe these are, right? So how safe are HOA loans? And then are you limited, right? So are you limited to,
Me as a company?
as a company, are you limited to work in only certain states? But first off, like, how safe are these loans?
For the board or the bank?
Both. Talk about the board first.
Yeah. Super safe. Safe as long as your homeowners are paying, right? But I think from let's get the project done standpoint, and let's do it as efficient as possible. It's as clean as you can get. You're making a commercial loan to an entity that represents a community of homeowners, and the collateralization is the future assessments of the community. So the bank will take an assignment of the association dues as collateral. It's cheap to do that. It's easy to do that. It's a lot like a rent roll for commercial real estate. It's just proving the income that's coming, and they're going to want to have that collateralized for the duration of the term of the loan. So if you have a 7-year loan, you're more than likely going to have a 7-year assignments of those dues.
And from
So
the
it's
bank's
safe.
perspective,
Yep. And so I was getting there from a bank's perspective. It's safe too, because it's this guaranteed source of income for the duration of your term that's affordable. You can't put a junior position on this. I mean, you will be in first position. So if ultimately the HOA stops paying you, you step in on behalf of the association and collect payments directly from the homeowners until you're full.
you could get kind of granular on this, but a question that we get at HOA Assist when we're doing the financials is, if you have a loan, can that loan be passed on to the next homeowner? Right?
Yeah.
Is that common? Is that uncommon?
Yeah, I mean, homes are typically changing hands all the time, frequently, right? And so it really depends on the state and the way your governing documents lay everything out. But casually, more often than not, yeah, you can either assume it or you can use proceeds to pay it off. I mean, there's many different ways to do it.
Mm-hmm. Where are you seeing this go 2 years, 4 years, 6 years down the road?
The market?
Yeah. Is this going to be way more necessary in a couple years? I know no one has the crystal ball, but I think are you finding more HOAs borrowing now than you did in the past?
Based on the sample size that I have, yes. But I would say the caveat or asterisk to that is most associations haven't been thinking about it. So they're financially not planning for it. It might be a request at the board meeting that's like, hey, we should look at taking a loan out. What have you been doing to get your house in order over the last 12 months to make sure you can take a loan out? Because for as safe as it is from a collateralization and repayment standpoint, there are a lot of metrics that banks really hold true in regards to underwriting and eligibility that can disqualify you quickly. So I've seen boards, do their best they can to have everyone on the same page, walk in the same way, but their financials are a mess. They're not following the reserve study. They don't have a reserve study. They don't know what legislation is being passed. They're plowing through their reserve balances. Their delinquencies are out of order. I mean, it can get ugly.
Mm-hmm.
And there's not much I can do there other than kind of hold their hand and get them to a point where I think they'll be presentable, and then see what happens.
What percentage of HOAs are you seeing that are taking out loans for capital improvements, or simply, you mentioned it before, kind of catching up from not funding their reserves properly or not having a reserve study? They're completely underfunded. Your asphalt and roofs and all that is, your useful life is almost to the end, but you only have 10 or 20% of what you need to pay for that. Like, how often are you, like, is one more common than the other?
No, but I mean, again, if you want to go back to the anatomy of how this lending is put together, you can borrow 100% of the project costs, sometimes more. You know what I mean? So like, why wouldn't you? Protect your cash. It's hard to build those accounts up. Save the cash for your operating expenses and any kind of unforeseen future expenses. Borrow. The rates are good. Like, now's a great time.
So if you have a $100,000 reserve balance and you've got $200,000 in projects that need to happen, you're saying don't touch the reserve account, and you could borrow that full 200,000, maybe even more, to kind of catapult the association in a better financial position.
I mean, what happens if you use that reserve account?
I mean, when you liquidate, dude,
you know what I mean?
Yeah.
I mean, you're going to be in a whole bucket of trouble.
You're way less likely to be able to sell property in that community. Your values go down.
You want to have that conversation with your homeowners? Hey guys, we're doing this project. We still can't finance 100% of it. So we took a loan out and we liquidated and are now insolvent.
Yeah. Get ready for a special assessment.
I mean,
on top of that,
you're kicking the can down the road and making it worse. Do you know what I'm saying?
Oh, yeah.
So boards can do whatever they want to do. They usually do, even if it's against good advice, I'd like to think. But there are ways to leverage yourself and put
in fairness to that, though, board members, yes, it can be the wild, wild west out there. There's a lot of good boards out there.
For sure.
Right?
I'm not saying that there's
a lot of good boards out there that I think, in their defense, this is just new waters that they're swimming in.
They probably took this boardmanship over from a bad board that wasn't following directions, or maybe they were making decisions out of concern for what their life was going to be like in the community. You know what I mean?
Oh yeah.
So they were
oftentimes it's just, hey, no one's running for the board. Does anyone want to go? And you kind of look around and it's like,
I'll do it.
I'll do it. I don't know what I'm doing, but I'll volunteer.
Yeah, and so it's like,
and so their backs are against the wall from day one.
They live next to a homeowner who's just a loudmouth, and they know that they're on the board, and so it's pressure. It's a lot of pressure, and so yeah, there's no crystal ball, but I will say, like, too, you're seeing right now in certain markets legislation being passed that's forcing the hand of some of these associations and management companies. Mm-hmm. So whether that's having reserve studies on hand, whether that's having an ample amount of cash identified as an alternate source of reserves, so you have the ability to do projects. It's crazy.
So I'm a board member, and I say, I want to hire HOA Capital. And I know McKenna will talk a little bit about this, but what can I expect? What can I expect from you as far as, questions would be, how quick is this going to take? Like, what's the process? What information do you need? Again, I know McKenna's going to cover some of that, but basically, you're in between the board and the bank. You're in
Constantly.
between the manager, the property manager, and the bank.
Yeah, it's like
So you're negotiating on their behalf.
an intermediary between the three. Yep.
Because you speak the language, you and your team speak the language, you know what to do, and you're going to now package up this couple of proposals for the manager or the board and say, pick which one you think is best. You obviously are able to consult a little bit,
sounding board, yeah,
and say, based on what we've seen and knowing what you want through our conversations, right? I know what your goals are, board member.
Let me walk
I would maybe recommend that, or I would maybe recommend this. So they're not on their own.
Yeah.
You give them a proposal, they're not on their own.
No.
You guys are still there.
Always. And they can be as involved as they want to be or as distant as they want to be. So a couple different ways to answer that question. And to do that, I'll back up to how I got to this point. Typically in the past, a manager would get a proposal from the bank, the management company he banks with. Right? Hey, I have a potential loan. I need a proposal for $500,000 or $1 million, whatever the project is. They get that and they may not know if it's good. They may not know how to answer the questions of, is there a prepayment penalty? How is this rate calculated if there's an adjustment? Can I waive this? Can I negotiate the fees? Can I negotiate the reserve financial deposit requirement, right?
Mm-hmm.
They're just happy to have a bid, bro. Because then the board asks a question and they're like, hey, I got your proposal.
Yeah, manager's going, I did my job, but I know nothing about it.
And I'm like, let me ask you something. You know what I mean? And so I can go get you bids in 24 hours, 48 hours, 72 hours, however many bids you want. It depends on how good the deal is. Some banks might bow out, but quickly. And as a board member and a manager, I'd want more than one bid. If I'm doing a roofing project, you're not having one roofing contractor quote you a bid, hopefully. You should have 2 or 3 and making sure that you're getting an honest proposal. So for us, that's what I love to do is give them 2, 3, 4, 5, 6 proposals and let's talk about them. And so the process, to answer your question, we have a discovery call with the board. Hey, my name is Matt. Here's my company. This is how we can help you. This is what we do. Here's some testimonials, whatever they want to see, right? Peek under the hood. Hey, Matt, yep, we spoke. We want you to represent us. At that point, I would send them a copy of our agreement to sign. We don't get paid till the loan closes. I would work with the management company, or if they're not managed, usually the treasurer or someone who does the books. Get the financials, income statement, balance sheet, current budget and delinquency report. Kind of triage that, make sure that everything looks like we're eligible, I guess, with that information. Send it off to our lenders, get our proposals back. Again, usually a couple days is how quickly that is. Meet with the board again. We'll go through all the proposals on a dashboard that we create. Everything's pretty brainless, right? Column A for column bank A, column B for bank B. They select a lender or have me negotiate something if they're close. At that point, when they've selected a lender, 90% of the board's work's done. I'm working with the management company at that point, or again, the treasurer, to go through all the historical financials and make sure things are clean, working with the bank's underwriting team and approval team. And this usually is what takes the longest. And then once we get all clear to land the plane, we'll get a draft copy of the loan documents ready to review and out. You can have your attorney review them if you want. It's extra money. I mean, every bank's going to have their standard set of loan docs. And then we close.
What's going to disqualify you from getting a loan proposal back? So ABC Townhomes comes to you and say, hey, we want $1 million or we want $500,000. What are some things that to get your house in order, like you said, what are things that banks are looking for that's gonna take you off the list of being able to qualify for a loan? Yeah,
I mean, there is a gray line, but it's fine. I mean, it's not like this wide gray area.
Delinquencies,
unit size, but I will say unit size, you have some wiggle room to make exceptions to those policies. I don't speak for the bank, but I've seen that happen. Hey, we only lend to HOAs that have 20 units. Well, here's one with 16 and everything else is clean. Cash flow looks good. Delinquencies look good.
And that's where you come in to negotiate and push that through.
Yep. Or, hey, I have 500 units. Well, my next question is typically how many of those are rentals? Right. And so keeping that number around 50% is huge, very important. So most governing documents don't have rental caps. I always encourage boards to look at getting rental caps. I think it's important for your community and also for these instances. How many of those rentals are owned by a single investor would probably be my next question. We would look at your delinquencies. How many of those delinquencies are past 60 days past due, assessment related charges only? Keeping that under 10%, sometimes 8% is huge. I mean, as an association, why aren't you collecting these payments? Why are you kicking them out?
There's a lot. I mean, it's a little bit of
I
a loaded question.
understand
There's a
that.
lot that goes into that.
I understand that, but like even in the example of like a probate, that's a little more difficult, right? But you're trying to work with people and you're trying to be lenient, but then you get bit by the hand that is trying to help.
Yeah, I mean, we've said it a million times. Like, you need to treat this as a business. This is not a book club. It's not a social hour. You can make good friends and have good times as board members, but you kind of have to put the hat on of what's doing best for the entire. It's not fair for Susan to not collect dues, and everyone else is paying their fair share of what they contractually owe the association, and she's allowed to skate by. You gotta tighten the grip on that.
Yeah. So, I mean, that's kind of some quick bullet points of what banks will look for. There's more. There's a wide gamut of things, but that's pretty standard. I think the biggest thing for us, right, us being HOA Capital, we are a pioneer going west in the fact of how infant this place is that we're discovering.
So what you're saying is, in other words, this is going to become way more popular over time.
I think it's going to become way more popular.
Or necessary.
You're seeing the debt increase per household. You're seeing the debt increase per company. It's just normal to borrow. I think people are becoming more normalized with it. And it's also a useful tool. I mean, you can use it as a tool. Not every homeowner needs to take advantage of it. I mean, if you have 100 units and 10 of them want to prepay, fine. Let them. I mean, what a great option. Hey, homeowners, the other 90 who aren't prepaying, we have a plan for you. Not, hey, I need your money in 30 days.
Right.
You know what I mean? So I always just encourage people to understand. I mean, if there's anything you and I can agree on in this business, it's like, let's help people understand and educate them on what is going on. Most people honestly have no clue what they're getting themselves into when they buy into an HOA. They're happy to have a house. Maybe it's a first house. Maybe they're empty nesters. They want, you know what I mean? And so it's like, if it's used and lived in appropriately, it's a great tool, just like finance. But let's understand it. And so that's what we do. Honestly, like I love just teaching and walking through and explaining and negotiating. And I do love that piece of it. It's a fun thing that I enjoy, but I want to help people.
Yeah. Yeah. Well, I mean, it's necessary. And we see that on the financial side, right? Because we're doing the financials for these HOAs. We recognize the ones that are low cash status,
and what do you say, dude?
Or we're having to choose which, help the boards understand that we have to figure out which vendors to pay because you don't have the money to do this. It's not wise, board members, to borrow from your reserve account. In a lot of states, it's like against the state statute. You can't borrow from your reserves to pay operating expenses. And yet, there's no association police that's going to go out there and fine you for it or something. So what's the regulation really? It's not really there. So you have an option now, like you said, a tool to be able to say, okay, maybe it was a past board that kind of neglected stuff. Maybe you just need to kind of catch up on funding your reserve account. This is an option for you that really a lot of HOAs are taking advantage of right now because no one knows what's going to happen with rates. It's an election year. We have no clue what's happening there. And so it's almost like, why not, and tell me if I'm wrong, it's almost like a hedge a little bit for the next 5 to 10 years. Yeah. You're hedging your bet on if we like a line of credit, right?
Yeah.
So that would be a huge financial tool.
I would encourage every association to open themselves up to the idea of having access to a line of credit.
Because we've seen all these increases, whether it be, I mean, could you use I don't even know this answer.
Insurance
could you,
premium?
Yeah. Could you use a line of credit to pay?
Sure.
And then I want to pause there because that's a huge
Yeah.
like
What happens?
issue,
You
red
get-
flag right now in
let's-
this entire industry.
Let's explain that. Hey, my insurance is coming due in the end of July, in 10 days, a week, sometimes the day before that expiration. Then your insurance agent comes in with an updated policy renewal, and it's 100% over what your premium was last year.
And you did your budget 6 months ago.
And you have no clue how to pay for it.
Yep.
But if you don't have insurance,
now you're really screwed.
Legally, you need it.
Yeah.
So
Good
they
luck.
have all the leverage in the world to wait. And so for you, be proactive.
I mean, that's a bad agent. We all know that's a bad agent, but they're
for
out
sure.
there.
For sure. Just like there's bad bankers,
Yeah.
just like there's bad lawyers. And so I think just be more forward thinking and forecasting ahead, even if you're not going to be in the community that you think long term. Who knows? And the other thing that I think is hilarious is you have a board, we meet, we talk about their project. Hey, Matt, we decided to kick this into next year.
When building costs are going to increase.
That's my first thing is before I slam my computer.
Those contractors aren't going to get cheaper.
And who knows what's going to happen with interest rates? Inflation is going through the roof. What are you thinking? Like, even if rates go down, you can refinance. But if rates go up, you're subject to the higher rate. Tell that to your homeowners.
Mm-hmm.
Do you know what I mean?
So grab your torch and pitchforks.
It's just like, let me ask you something. Like, I don't get it. I don't get it. So, for us, I welcome any conversation with people. Again, going back to the nucleus of the issue, I just want to help. And it's very foreign. Like, everyone's so programmed, management companies and managers included. I got to go to a bank. Why do you have to go to a bank? Why? And when you want to sell your car, are you first going to a dealer?
Probably not.
No, you go on Kelley Blue Book, you talk about your car, you kind of build your situation, how many miles, what year it is, and it spits out to you a quote. That's what we're doing. We're understanding your association. We're really taking into account the specifics and what you're landing on. Do you want a 10-year, 20-year, 15-year, 3-year? Do you want a year of interest only? Do you want, what kind of covenants or restrictions do you want? And we build something for you.
A lot of options. A lot of options.
Yeah.
And I'm just going to go back to the line of credit conversation real quick, because if you have that as a board member, right? Even as a property manager, right? If your community has access to $1 million line and something unexpected does happen, or, you have this safety net here. I love that idea, right? I mean, we've talked about it before, but even in this conversation, I'm liking that idea even more and more, because I have clients right now that it would be a game changer for them to have access to these funds, because they're losing vendors right now, lawn and snow vendors, contractors,
Sure.
because they cannot make the payment on time. And the contractor has to pay his workers,
Supplier.
his employers.
Yeah.
He's got to pay materials.
Yep.
And so now they're coming to
It's a ripple effect.
us that say, hey, we need a check for $50,000 because our contractor keeps calling us because we don't, he needs money. We can't cut that check.
Yeah. Yeah. You are preaching to the choir, man.
Yeah,
I think
that's good.
Lines of credit are great. Not all banks will do them, but the ones that do are, they've understand it.
And we're not saying go out and just get a line of credit.
No.
We're saying open yourselves up to the idea of having the conversation with your board or your manager or whoever, or you, to say, what would this look like for our community? It's not like just dive in the pool because we don't know if a shark's in there.
And honestly, just to really, really, really get granular here, or not get granular, go the opposite way, more macro view. Why a line of credit versus a loan? Easy. You're not paying interest on what you don't borrow, right?
Yep.
So you have access to cash. You're not paying on anything unless you're using it. Whereas a loan, you would be right out of the gate. You know what I mean? So yeah, you're opening yourself up to, a variable interest rate, but it's such a good tool. It is such a good tool.
What percentage of HOAs would you say do qualify? We touched on what disqualifies you earlier, but like if you out of 10 that come to you and they're, relatively standard, it's not, a 4 unit, it's not, like what are the odds? So people that are listening to this right now that they live in kind of your standard 50, 70, 100 unit townhome or
Yeah.
condo or something, like what are the odds that they do qualify for a loan
I would say
or
half.
a line of credit?
Half. And I want to, without getting too in the weeds, I guess, and everything, it depends on the makeup. Is it condos? Condos have a higher rental rate, but they also have higher assessments. Are they single families where there's really not a lot of common area and there's more owners, but they probably don't need as much project. So like their payments compared to assessments is more in line. You know what I mean? So like there's no answer. There's no stamp. But I would say
you got a coin toss on whether or not.
For sure. Yep.
So, it's not like it is far off thing, I guess is what I'm getting at. It's not like you have a 10 or 20% chance of doing it. Like there's a solid chance that you would qualify.
Honestly, dude, like what you're seeing in the market is everyone coming around to this idea. Like we've partnered with some of the largest software providers in this space, Vantica, Syncapfolio. Everyone's thinking about it, but everyone's like a little bit nervous on how to approach it. You know what I mean? And so like for us to try and be a resource for these people is great.
Because you've already created the blueprint.
Right.
Yeah.
And I encourage people to go and if they want to do this themselves while we do it too, do it. I'd love to work with the bank that beats me. You know what I mean?
Mm-hmm.
I just haven't seen it yet.
Love that.
Hey, I have a local bank. I use a local bank.
Which is cool.
I
like it's
love
honorable.
Local, dude. I love small business. I love local. They don't know how to price it and they don't know how to structure it.
Because correct me if I'm wrong, more often than not, that local banker, it's probably going to be their first ever HOA deal.
Yeah.
Or one of, and so they're navigating waters that they don't know how to swim in.
We had a client in Texas, one that you referred me, that we had our conversation with them. Everything was kind of on the edge of eligibility. And they wanted to go with a bank that they thought could beat us. You know what I mean? And so they signed our agreement and then said, no, thanks. And then I said, okay, well, just let me make sure if they did beat us that you are getting indeed a better proposal than what we could get you. After a couple of weeks, he shared it with me. And I said, with all due respect, I know we could crush this as long as it's not purely out of rate sensitivity, And he said, yeah, go ahead. We saved him $320,000, dude.
$320,000.
In interest over the life of the loan, we saved him $320,000.
That right there, you should put that on your website.
I should have it.
Should totally, dude. You should put that on your website.
No, that would be sweet.
Yep, like a little ticker that says like we've saved X amount of dollars, or we've financed X amount of dollars. That'd be kind of sweet.
Yeah,
that's value, man. I mean,
well, dude, you don't think about that. You know what I mean? Like, for example, when people see your contract, right? The first thing they think about is what's this going to cost per month per homeowner? Am I right there? Is that a fair,
for the most part, yeah,
fair assumption? Why aren't they thinking about that from a lending standpoint? What's this going to cost per month per homeowner?
What are they thinking?
I don't need to do the project. We'll punch it in next year.
We'll just do some Band-Aid fixes for now.
What's a little more operating expenses? We'll bleed out our reserves. Do you want to fix the issue? You know what I mean? Like if I go to the doctor and I'm playing football and I blow my knee out, right? Painkillers and ice might make me feel a little better.
Yeah, I might out there for the second half.
Go get the surgery, dude.
Yeah.
It's not going to be what you're maybe used to, and it's going to be a little harder, but you will be better. You're better for it, man.
You're better for it, man.
You know what I mean?
Amen.
So,
amen.
Thanks, man. Thanks for having me on.
Yeah, it's good.
It's
Again,
good
this is Matt with HOA Capital. They're nationwide, so you don't have to be local to use Matt and his team. Go to hoacapital.com. Learn more about Matt and his team and his business. Give him a call if you thought this was helpful. Visit the website. Have a discovery call with Matt McKenna. And just see if it might be a good fit. And maybe it's not, and that's okay. But I think it's probably worth 10 minutes of your time as a board member or a property manager to just kind of flesh this out and see if you do have an association that's, on the brink of, or you feel needs some help. I think it'd be a great resource. It's definitely worth the conversation. So yeah, reach out, give them a call, drop the page a like, follow, and we'll see you next time.
Thanks, man.